In 1972, 50 companies represented 38% of the entire U.S. stock market. 2 years later, they had lost 64% of their value. The shareholders were destroyed, even though most companies survived. Today, 7 companies represent 32% of the S&P 500. The pattern isn't similar, it's identical. This matters because if you own an S&P 500 index fund, a target date retirement fund, or any passive investment vehicle, you're not diversified across 500 companies. You're making a concentrated bet that 7 specific stocks will continue justifying valuations that have never been sustained in market history. When Coca-Cola crashed 64% in the 1970s, it took 15 years just to break even. 15 years of zero return on one of the best companies in the world. The lower quality stocks never recovered at all. The mechanism that creates concentration is the same mechanism that destroys it. Understanding how it worked then shows you exactly what's happening now. This is Economic Pattern Vault, where we break down financial history to understand how markets actually work by studying how they fail. Each video uncovers the repeating patterns behind economic booms, debt cycles, and power shifts, so you can see what's happening beneath the headlines. If you find this breakdown useful, like the video, subscribe to the channel, and share your thoughts or questions in the comments. In the late 1960s and early 1970s, institutional investors concentrated their portfolios in 50 large-cap stocks that became known as the Nifty 50. These were considered one-decision stocks. You bought them and never sold them, because they were the best companies in America with the best growth prospects and the best management teams. The list included Coca-Cola, IBM, Xerox, Polaroid, McDonald's, Walt Disney, Procter & Gamble, Avon, and Eastman Kodak. These companies dominated the American economy and were believed to be permanently superior investments that justified any price. By 1972, these 50 stocks represented 38% of the total market capitalization of all U.S. stocks. That's even more concentrated than today's situation. And these stocks traded at P/E ratios averaging 41.9, while the broader market traded at a P/E of 18.9. The Nifty 50 commanded a premium of 2.2 times the market multiple. Investors justified these extreme valuations by arguing that these companies had permanently superior growth characteristics and deserved premium multiples. The most extreme example was Polaroid, which traded at a P/E ratio of 90. Xerox traded at 48 times earnings. McDonald's traded at 86 times earnings. Avon traded at 65 times earnings. The argument was simple. These are the best companies with the best technology and the best growth prospects. They're so good that normal valuation rules don't apply. Pay any price because you'll make money in the long run. Then the music stopped. In 1973, the OPEC oil embargo hit. Oil prices quadrupled. Inflation spiked to 11%. The Federal Reserve raised rates aggressively to fight inflation. The federal funds rate went from 5% to 13%. The economy entered a severe recession. Corporate earnings growth stopped, and the Nifty 50 collapsed. From December 1972 to September 1974, the Nifty 50 stocks fell an average of 64%. But the most overvalued stocks were annihilated. Polaroid fell 91%. Avon fell 86%. Xerox fell 71%. McDonald's fell 68%. Even the highest quality companies fell dramatically. Coca-Cola fell 64%. Walt Disney fell 77%. IBM fell 48%. The P/E ratios compressed violently. Polaroid went from a P/E of 90 to a P/E of 5. Avon went from 65 to 8. Xerox went from 48 to 9. The valuations simply couldn't be sustained when growth slowed and the economic environment deteriorated. Investors who paid 50 to 90 times earnings discovered that when earnings growth stops, the P/E ratio collapses to single digits. The stock price must fall 80 to 90% to reach a sustainable valuation. The broader market fell 48% from peak to trough during the 1973 to 1974 bear market. But the Nifty 50 fell 64%, demonstrating that the most concentrated and most overvalued stocks fell harder than the market average. The concentration created fragility, not safety. Here's the critical lesson that reveals the repeatable pattern. These were great companies. Coca-Cola didn't go bankrupt. IBM didn't disappear. Disney survived and thrived. McDonald's continued growing. But their stock prices collapsed because the valuations were absurd. The pattern is this: when passive money flows into the largest stocks regardless of price, it creates a self-reinforcing feedback loop. The stock price rises because money keeps buying. Higher stock prices increase market cap. Higher market cap increases index weighting. Higher index weighting means even more of the next dollar flowing in goes to those stocks. The loop accelerates on the way up, but on the way down, the same mechanism becomes a death spiral. The pattern has three stages. First, concentration builds. Passive investors don't analyze businesses or valuations. They buy based on size. The bigger the stock gets, the more money flows in. The more money flows in, the bigger it gets. Second, valuations detach from fundamentals. Growth expectations become embedded in stock prices that can only be justified by extraordinary performance for years or decades. Any company trading at 50, 60, or 90 times earnings is priced for perfection. Third, growth inevitably slows. No company grows rapidly forever. Markets mature. Competition intensifies. Innovation becomes incremental. When the growth that justified the valuation doesn't materialize, the compression is brutal. The shareholders who believed quality companies always recover learned that recovery means nothing if you overpaid. Coca-Cola eventually made new highs, but it took 15 years. If you bought at the 1972 peak, you didn't break even until 1987. That's 15 years of zero return on one of the best companies in the world. Today, 7 companies: Apple, Microsoft, Alphabet, Amazon, Nvidia, Meta, and Tesla represent 32% of the S&P 500. Their combined market cap is $14.2 trillion. These 7 stocks trade at an average PE ratio of 42. The historical average PE for market leaders is 22. Apple trades at 33 times earnings while iPhone sales are declining, not growing. Microsoft trades at 38 times earnings while Azure growth decelerates from 50% annually to 16%. Nvidia trades at 58 times earnings during a one-time AI infrastructure build-out that will eventually normalize. The bottom 250 companies in the S&P 500, half the entire index, have a combined market cap of $3.1 trillion. The top 7 are worth $14.2 trillion. 7 companies are worth 4.6 times more than 250 companies combined. When you invest in an S&P 500 index fund today, you think you're diversified across 500 companies. But you're not. 32% of every dollar you invest automatically buys these 7 stocks, regardless of whether they're overvalued, regardless of whether they're growing, regardless of price. The same passive mechanism that inflated the Nifty 50 in 1972 is operating today at a larger scale. There's currently $11 trillion invested in passive index funds and ETFs that track the S&P 500. The concentration isn't stabilizing, it's accelerating. In 2013, the top 7 represented 13.4% of the index. In 2018, they represented 18.7%. In 2020, they represented 23.4%. Today, they represent 32.1%. Every quarter, these 7 companies command a larger share of total market value. And every quarter, the risk grows more extreme. The takeaway is not that these companies will fail. Apple, Microsoft, and Alphabet will likely remain profitable for decades. The takeaway is that concentration creates risk and valuation determines your return. If you pay 90 times earnings for Polaroid, you can lose 91%, even though Polaroid was a real company with real products and real profits. If you pay 73 times earnings for Tesla, you're assuming growth that may never materialize. The pattern shows that when a small number of stocks dominate the market at extreme valuations, the risk isn't in the companies, it's in the price you're paying. Passive investing during periods of extreme concentration guarantees you hold overvalued assets. The index doesn't protect you from concentration risk. The index is the concentration risk. Understanding this pattern means recognizing that diversification isn't just owning 500 company names. It's ensuring no single event can destroy your portfolio. It's understanding that when 32% of your portfolio is in 7 stocks trading at twice their historical multiples, you're not diversified, you're concentrated. The Nifty 50 taught one clear lesson: Great companies at absurd prices destroy wealth. The quality of the business doesn't save you if you overpaid. History doesn't repeat itself exactly, but financial behavior does. If this breakdown helped you see the pattern more clearly, like the video, subscribe to Economic Pattern Vault, and share your perspective in the comments. Understanding the cycle is how you stay ahead of it.